welcome back to Metals and Momentum. My name's Anthony, and this is going to be an interesting video because we got a lot of charts to go over. I've also kind of identified something to do with the S&P 500 and some of the blue chip stocks like the Walmarts, the Exxons of the world in terms of the market there, and there is a definite capital rotation, and I definitely want to go over that. Now I'm going to separate this video into sections for my free members over on Substack. We go over charts, and we put out investment thoughts on Substack. One of the ones that we're looking at here is the stretch stocks, stocks explained using an elastic band. And this was a great article to tell you a story about how things can get very expensive, and generally when that elastic band starts to snap back, generally we're going towards fair valuation, and sometimes we will overstretch when we're stupidly expensive. We will overstretch back down not just to fair valuation, but will actually snap back down to dirt cheap. This article that I wrote here, Stocks Explained Using an Elastic Band, tells you a story of exactly how much return you can expect when things are dirt cheap, and then when they snap back to fair valuation like it's doing right now. This right here, this is the movement that you really want to catch, and that's when there's very little risk versus the reward that you're actually expecting on a stock when it goes from dirt cheap to fair valuation. Right now, a lot of stocks are stupidly expensive, and we're actually seeing a capital rotation out of stupidly expensive stocks to those stocks that are about fair valuation. And these are blue chip stocks that we're going to go over in the charts. But there's a number of charts that we're actually going to go over. We have to start with the S&P 500 because this really does set up the whole story for everything else that I'm going to explain throughout this video here. And you're going to notice some very interesting things, okay? So first of all, we've been following the S&P 500 since last year. And this is an important market to follow because when the S&P 500 is rising, a lot of the other stocks are also going to be rising as well. There's a fair amount of momentum in the S&P 500, but what has happened recently, and really since October of 2025, is we started to trade sideways. And this is really sucking a lot of the momentum out of some of the other stocks that are in the market right now. And when the S&P 500 starts to roll over, then you need to start to think about exiting some of those risky positions, because a lot of stocks will go down during the movement downward in the S&P 500, and that's when you want to step out of the way. And especially if you're like me and looking at this chart and thinking like, oh my goodness, okay, so if we start to stall out here and actually roll over, where could we potentially even go? And we've really been failing to break out of the $7,000 kind of price range that I have up at the top right here. We've been failing multiple times. We tried back here, even like I would say this was an attempt right here, even though we're not quite close to 7,000, it's still an attempt, I would say. We have this point right here and this point right here. Multiple times throughout the recent history, we've been trying to attempt to break out of $7,000 and continue this uptrend right here. Basically, we're looking for something like this to happen, but that is not happening whatsoever. In fact, now that we're stalling out here and actually going more like this, what's likely going to happen is retail money is going to run out of money to invest, and they are going to start to experience the outflows of the S&P 500 that big money is actually doing. And you can actually tell that big money is leaving the index, because if you look at the relative strength index, you can actually see the relative strength was actually very high during this period right here. So back in July, even I would say even May, that's pretty high on the S&P 500. And what you could see is the strength is very high all right here. And what do you see happening on the charts? You have that upward momentum going into the S&P 500, but the relative strength in the index starts to decline. Look at this. We have, I'm actually just going to get rid of these so it's a little bit more clear. Once you reach this peak right here, what happens to the relative strength is it starts to actually roll over. And this is a sign that big money is actually starting to leave the index, and I'll show you something even a little bit more insane in a few minutes here. But big money is starting to actually leave the index. The strength of buying in the S&P 500 is declining, and that's when you start to see this top out, and we've really traded sideways for a fair bit of time here. We actually haven't really broken out to that new all-time high, which happens to correlate with a $7,000 price target. And you know, if you've been in markets, these markets love big round numbers. These are the numbers that people tend to sell at or really struggle to break above. For example, big round numbers like $5,000 gold, $100 silver was a big one. Like if it broke $100, then that means there's going to be some significant downside. And what do? We broke $100 in like a matter of a day. So these big round numbers are really important to pay attention to, but what's even more interesting is that relative strength is starting to decline. And that to me signals that there is a lot of retail buying in this market, but there's very little institutional buying in this market. And as this S&P 500 started to decline during these periods right here, what I started to notice is I started to look at the number of stocks that were actually green on the day. And you can even actually see it right here. Who is actually green? This is as of Friday. So I'm recording this on Sunday, February 15th. This is as of Friday. What would that be? That would be the February 13th. So these, what are the green stocks that were actually up on the day? And it's a lot of the time was these big blue chip stocks, like for example, Berkshire Hathaway, Walmart. Walmart was one of the first ones on my list to see that, as the S&P 500 starts to sell off, you start to catch a bid in Walmart. And that is smart money going out of the large index and going over to these blue chip dividend paying stocks. Like I noticed Exxon was one of those ones that kept getting a bid as the S&P 500 started to come down. So what I've done for you here on this chart is I've overlaid the S&P 500 is the blue line and Walmart is the candles here. And what you've noticed as this S&P 500 starts to roll over, you start to catch a bid in the Walmart shares, right? So almost every decline recently in the S&P 500, you've got that bid up in Walmart, and you can see it actually happen multiple times. And also you could see the relative strength is also coming downward into this areas. You get these gaps downward in Walmart as the S&P 500 starts to continue on, and that's capital rotation happening. And now what we've seen is Walmart just get a fairly significant bid upward, but the S&P 500 has traded sideways. And this is a sign that big money, smart money, big institutional investors, they're rotating out of risk and going over to these safer dividend essential type of stocks. And Walmart is just one of those examples here. We see that big decline in the S&P 500 multiple times, especially this one right here, and then Walmart just getting big green candles. That means big money is flowing into these blue chip stocks. So that's a very interesting chart that I've went over in the investment newsletter that I sent out. The newsletter that you're looking for is linked down below. Live through one cycle and you've lived through them all. Investing while the bubble deflates. This is the title of the newsletter that you want to take a look at, and I'll show you a number of different other stocks that we're looking at in the weekly watch list. So that's the S&P 500. I've explained this whole capital rotation happening in Walmart as well. And then, like I said, I'm noting that RSI, that decline in the relative strength of buying. That's something that's super important to watch, because that is signaling that there is going to be a decline in the S&P 500. And my guess is it's probably going to take us back down to this third support line. And I'll just make this a little bit larger so that way we can get a good a little view on the S&P 500 here. So we see that the relative strength is slowing down, and we're getting these larger decreases in the S&P 500. So for example, even back here, you start to get somewhat significant pullbacks starting at more like 3 or 2%, but then you start to get these bigger declines. This is more like 5%. And then even here, we get a return of a little bit of strength. I'm just going to take these out of here. You get a return of a little bit more strength, and the declines start to get a little bit weaker, right? But as you get closer and closer, the strength of buying is continuing to pump things and keep things slightly afloat. But as this gets weaker and weaker, what you're going to end up seeing is bigger and bigger declines in the S&P 500. So we've even started to see that happen right here. So 2.91% on this decline right here. And then even right here, 2.73, bigger declines than what we've seen back closer to around here and around here and around here. All of these declines are getting a little bit more aggressive, right? And that's because you see that capital rotating into the big blue chip stocks like Walmart. So what's going to probably end up happening is eventually this buying is going to run out of steam. You're going to get retail money fully invested in the S&P 500. They're going to be all in, and that's not going to be enough to hold up and pump the market back up to this $7,000 price target. And we've actually seen this starting to happen right around here. You get a little bid and then a straight decline once again. What's probably going to end up happening maybe even this week is we're going to try and get a little bit of retail buying, but it's not going to be enough. And then you're going to start to roll over to this third support line right here. And by that time, the S&P 500 will have that 200-day moving average up a little bit closer to that support line. And that's going to meet with the chart here. So this 200-day moving average is the blue line. This is going to creep upward and then provide a little bit of support. Now, if we break that, and let's say that 200-day moving average creeps up to somewhere around here, if we just smash right through it, that is going to be that's going to be a huge signal that we are definitely heading lower on the S&P 500, and that next support line on the S&P is 61.28. That's going to erase all the gains that we've seen in the market since 2025, and that's going to take us back to the peak right around this would be January 2025. That's going to completely wipe out all of the gains that we've seen over the 2025 period. And we don't want to be the type of investor who just buys and hopes that things go up. And that's what really all this newsletter is about and talking about. And we want to trade with that momentum. As momentum starts to get sucked out of a market, we want to be the type of investor that actually leaves that asset, index, stock, whatever it is that you're following here. So I'm saying to my Substack subscribers, let's prepare for a deflationary event. That's going to correlate with the stock, the overall broad markets going down. And that's one of the things that we're talking about here. Let's move on to a different asset, something a little bit more exciting and a little bit more crazy at the same time. Silver. The silver chart does not look good, unfortunately. We've broken a number of different levels of support and just smashed through it on that big decline on silver there. We actually called this on the channel. We were saying at 119 that silver would look to retest that $71 kind of price point. That was my price target at 119, and look what has happened ever since then. We've retested that $71 price point. We're getting a small bounce. We're probably going to come back and retrace down to 7,100, and if that does not hold, then my next target is going to be that 5,400, and this would be the big buy zone for me. We have key support going back to November. I'll even pull it up on the trading view here. We have key support coming back, and let's get the date on here. This is October of 2025. We've reached that top in silver. Look at the nice little run up that we had, and then we started to trade sideways, get some consolidation happening. We have a retrace, 1, 2. This is actually even considered a cup and handle pattern right around here. We have that cup form the handle. That's extremely bullish. You go to the upside, and oh my goodness, we definitely moved to that upside here. And then look at this, we have even a cup and a mini handle break to the upside. That was signaling that there's going to be another move up. And then once I started to get closer to that $100 price point, I actually started to sell off some of my physical silver, or actually all of the rest of my physical silver around this area right here. Then we saw the topping tail on physical silver. That's when I put out the price target of $71. I was just playing it out in my head here. If we break that $100 price point, that's going to be key psychological level. I didn't know it was going to happen in one single day, but that's how it works. And yeah, the key thing to watch is the $71 price point here. If that fails, we're going back to $54. And what's going to be interesting about $54 is not only do you have the key support from the cup and handle pattern back in 2025, but you also have that 200-day moving average starting to creep up. That's probably going to meet that $50 kind of, or $54 kind of price point. And as that moves upward, what you're going to see is that's going to be some key support. If the chart comes down and meets that 200-day moving average, you're probably going to get a significant bounce, probably closer up to $7,100. Or sorry, $71 on the price of physical silver there. So I'm going to be remaining cautious, especially if the S&P 500 starts to do this. Then my goodness, silver is not going to hold up either. It's going to get hit alongside with broad markets, and you got to be fairly cautious on physical silver. Look to have that longer term horizon if you're purchasing silver, because any kind of bump upward is probably not going to be sustainable at this moment in time. Now, that's not to say in the future, maybe 2 years, maybe 3 years, 4 years, 5 years down the line, I think silver is probably going to be a lot higher than what it is at today. But you just have to have that longer term horizon. And there's no indicators on the chart right now that's saying that we are going to return to 119 whatsoever. In fact, I think it's just going to be the opposite. We're going to go down, retrace down to that $54 price point. And then we can start to get a little bit more bullish on silver once again. One of the things that also I'm monitoring is the 30-year US Treasury bond. Now, this is essential to monitor as well, because this this charts the path of interest rates, and especially those long-term interest rates. As the US Treasury starts to lower interest rates, one thing I'm noticing is that the long end of the curve, the long-term interest rates, are actually starting to rise. And we've established this clear uptrend in the price of money, really. And we have the price of the 30-year interest rate resting alongside the 200-day moving average, but a clear uptrend. I've charted the potential path of these interest rates going something like this. Generally, I'm thinking that it's going to continue this uptrend, probably form some sort of like head and shoulder pattern, tap out around the 5% interest rate kind of area, and then maybe head lower, because that would correlate with a large decline in the stock market, and then the U.S. government is probably going to be screaming at that point for dramatically lower rates. We're going to get a new chairman of the Federal Reserve. By that time, we should be able to see lower interest rates. And that should take us back down to somewhere around this trend line right here. Depends on how fast we get there. Like if we start to just go down from here, then that could be somewhere closer to 4, maybe 4.3, somewhere around here. But if we start to get a rise in interest rates and tap this kind of, I would call this like a ceiling, this point right here, 5% interest rates, then we start to get a little bit of a higher decline, probably actually somewhere close to where we're at right now, 4.6, 4.7, 4.5, somewhere around this general area. That's what I would be expecting on interest rates. But the key thing to understand here is when you're slamming interest rates down aggressively, that is not good for stocks. But also when interest rates are rising and going up to 5%, that's also not good for stocks either, because stocks are very much dependent on getting access to debt at lower rates. So if interest rates are rising, that's not good. But also if interest rates are slamming downward, that's not good for stocks either. And that's the key takeaway with the 30-year Treasury bond. The last chart for my free tier that I'll go into is Bitcoin. Bitcoin is looking very interesting from a short perspective. Let's go over to this chart right here and see what's happening on Bitcoin. So in the last little while, what we've seen is Bitcoin experience this head and shoulder kind of price pattern. So I'm not too sure why actually the chart's not loading fully, but basically we were trading upward. We created a head and shoulder, first shoulder right here. We have the head going back to the high. That was closer to 126,000. Then we started to trade downward. We have the head and shoulder fully played out right now. And basically you can measure out the movement of the head and shoulder pattern using the head to measure from the peak to the neckline. That's what this measurement would take us downward to 35,000 or 33,000, somewhere around this general area. There's also a support line down at 31,000. And this is also pushing the other area where I'm not too sure why this chart is not loading here, but we had a peak back in 2019. That was this $14,000 kind of price point. There is definitely potential for this head and shoulder pattern to play out all the way down to that 2019 peak and just essentially erase all the gains that we've seen since then. But the real measurement that I'm looking at, and the scary thing is that we could definitely see a 57% decline from the neckline. Now, we've started that transition or movement down to the 31,000, 33,000 kind of price target. But what we've seen is a little bit of strength form in the Bitcoin chart right here. We actually have a bull flag forming up here. So that's why I'm thinking maybe we could start to retrace back up to the neckline. And that's when I would start to be very, very interested in going short Bitcoin, because if the S&P 500 is also declining, Bitcoin tends to be a leading indicator. In fact, on Sundays, if you look at Bitcoin and see what the price action is trading like, generally you have a good idea of how the markets are going to open up on Monday. And that's why I'm looking at Bitcoin and thinking, if we start to retrace and kind of pull back towards this like 82,000, 80,000 kind of price point, that's when I'm going to start to get really interested in going short Bitcoin. And you can easily do this using inverse ETFs and look for a further pullback. And I've just measured out some general price targets of if you were to enter into a short position, what's the potential profit here? So if you started to say enter into the short position around 71 to 73,000, even if it went up to 80,000 or so, then you'd still be okay to hold on to that short position and wait for that retrace down to the 49,000 kind of price point here. There's a support line going back. Again, I'm not too sure why the chart isn't loading here, but I think that's where another key area of support here is, and that's a lot of profit that you could potentially make here. 33% to the downside here, but your max amount of profit and how that head and shoulders would normally play out would take you 57% downward, closer to 33,000. And a lot of these Bitcoin companies that were just adding Bitcoin into their treasuries and storing Bitcoin as that safe haven asset are totally seeing that Bitcoin just decrease in value. We've seen a massive decline from the peak. And I think a lot of companies are not interested in holding Bitcoin on their balance sheet if it's decreasing by 50 something percent. And then on top of that, if we go another 50% lower, yikes, that's crazy. I think a lot of companies are going to start to dip out of Bitcoin, and that is going to start to put some downward pressure on Bitcoin going forward. So that is what I was looking at in the free tier of the paid, the free tier of Metals and Momentum. These are the stocks that I'm most interested in. I want to carry on this video and go over to the paid tier and give my paid subscribers a little bit more information on some of the charts that we were also looking at. We've entered into a couple trades this past 2-week period, and I want to go over those charts in a separate video. I'll send that out to paid members. So for my free subscribers, consider joining the paid tier of Metals and Momentum. It's $9 a month, and you'll get access to trade notifications. You'll get access to my longer term portfolio where we start to monitor some of those trends, and we're going to look at the charts from a longer term perspective and see those uptrends take us into potentially all-time highs, and that's where we're going to start to see those indicators that I use and start to use it on a long-term basis. For those who are more interested in holding things for a longer period of time, that's really going to be the key benefit to joining the paid tier over on Metals and Momentum. So hit the links down below. You'll see the articles that I wrote on this bi-weekly report. I write the investment thoughts on a bi-weekly basis as well. And these were pretty entertaining stories for you to read through. It's all linked in the description. Now let's hop over to the paid tier and go over some more charts. We'll see the free members in another video. Take care.